Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, instead of having a normal special guest, what John Manfreda and I are going to do is just go over some current events, some important news and information, along with some analysis of this news and information we think is important to our listeners because we haven't done one of these in a while. And then at the end of the podcast, what we'll do is we'll go through some of the other markets like the stock market, the bond market, commodities, those types of things, and give people some short-term trading ideas and some long-term value investing ideas from a contrarian standpoint. So we'll try to give both traders and investors some ideas here for the future. Okay, sounds good, John?
Yep.
Okay. Well, John, there's a few current events that you brought to my attention, a couple. And let's just go through some of those. Let's outline a couple of those first, and then we'll go in depth on those. So one of them is, and I think this is a major one, that the article is actually posted by Bloomberg, and we posted it on our Facebook fan page, and that is that all global central banks, well, not all of them, the G8, the developed countries, so Canada, Germany, the U.S., Japan, et cetera, and England, they're going to be doing. Remember those currency swaps, which were supposedly temporary, right? You had the one with Japan for Fukushima. You had one with the European Central Bank, right, during the Greece crisis and other things. Those are now permanent. We now have implemented permanent backdoor bailouts. So this is something that I have not heard enough experts talk about. They don't even have to come out and announce that the U.S. Fed does not have to come out and announce, hey, we're going to hand over $3 trillion to Japan, or we're going to give out $5 trillion to Europe. They'll just print the money and give out the loan in quotes, and that's it. We might not even find out about it at all, but it's going to get done now, no matter what.
Yeah, definitely. And it's highly inflationary. That means all this easing is going to go on permanently. I would say until someone from the emerging market says, enough, we're not going to absorb the inflation. So the main central banks, from what I read on Bloomberg, were the ECB, the Bank of England, Japan, and the U.S. And what we don't know is from what I got of it, is one of those zones is on the verge of a collapse. Which one we don't know, we have no idea. We can always speculate. I would guess it's Japan, because everything's bad. Everything's bad with them. Their demographics, aging population, electricity rates are sky high, so their exports are deteriorating. So I'm guessing it's Japan right now that they're backdoor bailing out.
Exactly, and if I had to give, like you said, speculate, but we can give a best educated guess, and I think that means that it is Japan. Some additional things on Japan. Japan has the largest debt to GDP ratio. They have the largest interest payments of total tax revenues of any country, right? I think that's a key component there. And they're also, for the first time in a long time, they've started to run trade deficits because of their Fukushima and all their nuclear power plants coming offline. They have all those expensive LNG imports, right, John?
Yeah. Oh, yeah, their natural gas is $16 per British thermal unit. And I was wondering, is you did mention the most expensive national deficit. Isn't it like a quadrillion yen?
I don't even know the numbers at this point, John, but we're at the stage here where they're way over 200% debt to GDP ratio, which is a lot higher than the U.S. But most importantly, though, they've manipulated their bond market to the point where interest rates are ultra low for a long time, but the total debt has risen to such a large amount that the interest payments on artificially manipulated low interest rate are a humongous percent of their tax revenues. So they're not going to be able to fund their government, any of their social programs, any of those other things. They just have to pay interest payments on the debt. So they're going to have to cut the principal on their debt eventually at some point, and the population, their pension funds, their banks, their corporations, they're all large net sellers now of the debt. There is no demand for the amount of debt that Japan needs to issue to keep this Ponzi scheme, and that is their government spending, going. So it's going to end. The tricky thing is the timing. If you really want more analysis of it, I really suggest looking up one of Kyle Bass's 45-minute or longer presentations. There's a whole bunch of them out there on the internet, on YouTube, or on Zero Hedge. I think he will be proven right over the long term. And, I think that is the major story, but, we don't want to spend all of our time talking about that story. The U.S., though, the reason I think this is inflationary for our listeners, and let me explain why. Japan does not have, let's say Japan is getting those trillions in currency swaps, right, John?
Yeah.
Japan does not have to work hard at all to earn that many more dollars. They don't have to produce any natural resources. They don't have to produce any more Toyotas. They don't have to produce any more amazing Sony innovations, right? The Fed just says, oh, hey, here's $3 trillion, right? Just to keep the status quo going. They don't have to work their butts off in Japan, the companies and the citizens, to earn any of that quote-unquote hard currency that the dollar is compared to the yen, for them to maintain their standard of living. And the Fed, the scary part, if you've read G. Edward Griffin's Creature from Jekyll Island, the Fed has done this before with, currency swap backdoor bailouts, and the other country has defaulted, where the other currency in the swap has collapsed. So this was done with Mexico before the Mexican peso exploded during the tequila crisis, where the U.S. banks were all holding bad loans and they knew they were going to get bailed out. The IMF, World Bank, and the Federal Reserve and the Exchange Stabilization Fund had to bail out the entire government of Mexico because they borrowed way too much just to maintain the same government in Mexico and, other loans. And so Mexico wouldn't hurt the banks and other large corporations and stuff like that. So the way the currency swap works, John, is, I'm the Bank of Japan, you're the Bank of the U.S., right? I print off 3 trillion yen, you print off $3 trillion or whatever the exchange rate is, and we just swap the currencies, right? But if I hyperinflate my currency and my currency collapses, you essentially gave me a loan I cannot pay back.
Yeah. Well, that's why the yen hasn't really been collapsing, in my opinion, is they had to do these currency swaps because it started easing in January, and you saw the yen take a free-for-all, but in April it's sort of held up a little bit. It's been stuck in a range.
Exactly, John. I think that's what's been going on behind the scenes. I think the other central banks, the developed nations in the G8, have been coordinating with Japan to help stabilize them to prevent the yen from going into immediate free fall to 120, 150, 200 yen to the dollar in a very short order. But we may still get that anyway if things start to come undone, if the other developed countries, bad things start to happen. And that's some of the stuff that leads us to our next current event ones. You can talk about those.
Oh, is it? I guess you want me to talk about what John Butler told me over the weekend.
Sure.
Which was, this was breaking news because it shows that, this hasn't been broken to the media, but it shows that Germany is on board. And he basically told me, China's gold imports are not unimportant, but their cross-currency arrangements are far more so. And they have now signed one with Germany, just you wait, ... And that's big because Europe generally waits for things to play out before they take sides. That's generally been the European mantra. During the 1980s, in the oil-producing wars, Europe didn't really, it was in their interest with the North Sea to have higher oil, but they started siding with OPEC when they realized USSR was on collapse and the OPEC would be controlling oil prices. But just in case you don't know, is I interviewed John Butler before last year, if you want to take a look at it. He wrote the book, The Golden Revolution. He runs a hedge fund and a newsletter. And
yeah, he runs a hedge fund in Europe, and he has some of the best European contacts out there. He knows a lot of the top financial and political contacts in Europe.
Yeah, and James Rickards even said his book, The Golden Revolution, was like a sequel. And basically in his book, what he said is that basically it's this. The emerging nations like Russia, China, Brazil, they won't be able to challenge the U.S. dollar their currencies with its own merit. And the only reason, the way they're going to challenge it and throw the dollar out of the world reserve currency is by using gold. And he said this about China, is that they are proactively preparing to provide the world within this. He also told me this weekend, with an alternative currency to that which is dependent upon the dollar. Gold reserves are part of that, but the gold is only required to settle BOP, balance of payments. The system is going to run on non-dollar currency, possibly a basket of some kind, although more likely just a huge surge in non-dollar bilateral trade, with surplus deficit residuals settled in gold. That is where this is going, and if Germany is now on board, which seems entirely reasonable to me, then a tipping point may well be near. And he also said something that's a good point, is that China's using the art of war strategy, where they're going to win this without ever having to fire a shot. That's what great generals do.
Yeah, and the thing about the art of war strategy, John, is that, you attack the supply lines. And in this case, the U.S. military is by far the strongest military, right? We have all the advanced weaponry. We've spent trillions of dollars, on all the best technology, research and development, et cetera, et cetera. So, fighting man-to-man, machine-to-machine is stupid. The U.S.'s main problem that can be attacked is the financial ones. So you just stop the supply chain there, and the U.S.'s ability to continue to inflate the dollar, allowing them to do unlimited spending. And that's what looks like is the game plan for the rest of the world there. They're just getting fed up with the U.S.'s ability to export inflation to other countries and to spend unlimited for D.C. and Washington, D.C. and Wall Street, to get as much money as they want and do whatever havoc or volatility with other economies and markets and stuff that they want. So it's just amazing, though. Like, in terms of bilateral trade agreements, we've seen, Brazil and China do small agreements. We've seen China do a lot of small agreements with other countries. But this story that John Butler told you that we broke, this could be a very large bilateral trade agreement, right, John? This is not Germany and China did a little one last year, the year before. That was a tiny amount of their trade settled outside of the dollar, right? But this could potentially be, we don't know when the announcement is going to officially come, for the record, but from what John Butler told us, the deal is already done. This could potentially be all of their trade between Germany and China settled outside of the dollar. Now, in terms of the total reserves, though, let's just put a caveat in there. Germany is not supporting the dollar anymore. They're not the ones who are buying, all the U.S. bonds, recycling their trade surplus back to support the dollar with, like, the petrodollar and what China's doing and Japan's doing. Germany used to do that, right? When Germany was industrializing after World War II, Europe was the primary group who was supporting the dollar first, post-Bretton Woods and after World War II. But Europe is no longer carrying that torch or that burden or whatever you want to call it. The main people in that role now is the Fed itself, either directly the primary banks, the hedge funds in the Caribbean who the Fed is backing, who are buying the treasuries, Japan and China, who are and then some of the other, oil and developing countries that are combined carrying that load. Europe is really not supporting the dollar. But like you said earlier in the this part of the segment, John, it's just important, though, that Germany may openly actually, say that we back China, we back Russia, we back this new system, because Germany is still, they're a top 5 to 7 player in the world economy. They're a big player, and yes, they're not supporting the treasury market, but that's still a big thing for the long-term stability of the dollar as a world reserve currency, petrodollar, that might end, that they're saying that, we don't like this current system, we're backing the new system.
Yeah, it's pretty big, and not only that, Europe is normally, just generally speaking, a huge ally of the U.S., and just when any country in Europe decides to turn its back on the U.S., that's not a good sign for the U.S. dollar, because Europe is generally always, historically, just a big friend to the U.S.
Well, not just friend, John. They've after World War II, for a while, they did whatever we wanted them to do, right?
Oh,
So
yeah.
they supported the dollar. They did the London gold pool. They pulled all their gold to get people into fiat currencies and manipulate the gold price. Look this up on Wikipedia. Look up the London gold pool. There's also a book out that came out from a former Swiss banker called Gold Wars. I think his name was Ferdinand Lips, called Gold Wars. This talks about the London gold pool in depth and how governments have always tried to manipulate the gold price. So in modern history, so this is just an amazing here that behind the scenes, it seems like the calm on the surface, John, right? You look at the stock market, you look at some of the things going on. It seems like there's very little volatility in a lot of the stock market, commodities aside, right? And it just seems that everything's fine. The VIX is volatility index options are at low levels, right? They're not going up and down like bonkers, and it just seems like things are fine. But we look at these stories, and it's like market manipulation, obviously, right? Because behind the scenes, you see these stories, and you're like, the market's not reflecting any of this stuff.
Oh yeah, especially since the bill, and this was reported by the Washington Times, so this wasn't even like a Zero Hedge or a King World News story. This was Washington Times, which is a mainstream press. They reported that Russia has a bill banning the U.S. dollar from its mainland, and that has not reflected anywhere near the dollar price.
And that's a good point, John. And you got to wonder that people are bashing this Russian politician for even saying, I think he's predicting the dollar will collapse around 2017, right, after the next elections. And you have to wonder, people are, this guy's a madman. He doesn't know what he's talking about. The U.S. is fine, right? The U.S. is recovering, blah, blah. That's what I saw as the retaliatory and the other comments underneath. But this guy had to pull, my guess, politicians tend to not take that strong individual stance and be willing to stand all by themselves like Ron Paul, right, John? They tend to be willing to only go where the wind is blowing, right, and they're willing to flip-flop and change directions. You have to think he pulled a lot of other people in his own country, and he kind of says, like, Russian businessmen are fed up with the dollar. They're fed up with having to do this and this and this and this and this. Because, Russia does have a large percentage of its trade surplus. They've been, once the Soviet Union collapsed, Russia had to work their butts off to produce more oil just to earn dollars to buy other goods, because Russia wasn't producing anything else. The Soviet Union didn't produce any goods, any consumer goods. If you listen to Jim Rogers, Investment Biker, he went through Soviet Russia, he drove through there. They had no, or anyone who lived in the Soviet Union and defected at the time, that they had no consumer goods. They weren't like Japan was capable of doing now, where they have Sony or Toyota or any of those guys who are quality manufacturers. They didn't have any of that. All that Russia could do to earn dollars was produce more oil or more copper or maybe a little bit more Solchenaya vodka or something like that, and that was it. So these guys, they're just deciding what they want to do with their reserves, John, and you're seeing it in the numbers. Russia's central bank is one of the few ones that publicly releases what they're doing with their reserves, and they've been buying more gold nonstop. I think for the last 3 or 4 years, their gold imports have increased massively. They don't let any gold leave the country, right, John, through mining, and they're importing a humongous amount of gold that they're putting their trade surplus to work. They're not holding as many dollars or treasuries.
Yeah, well, the funny thing is, speaking of gold mining, is China's the largest world's gold producer, and they're still a net importer. So who knows what their their real holdings are? We know their official holdings, but their real holdings.
Exactly. Now, John, do we? I think we covered a good amount of these current event stories. Do you have any other analysis or any more stories you want to cover before we go into market analysis?
No, not really. Just, well, Janet Yellen did say today that she basically said the Fed hasn't done enough to support the economy, which goes to show, I think,
oh man,
we've been saying this for a while, that they're not going to taper, they're going to increase stimulus.
Sorry, I just pulled a Dr. Mark Faber there with uncontrollable laughing at mention of the Fed in a statement like that.
That's the other thing, is if anyone didn't see the Janet Yellen testimony to the Senate banking today, they're laying the groundwork. We saw the New York Times article, I'd say a week ago, making the case for inflation. The Fed came out with it. I think the groundwork has been laid for more stimulus.
Yeah, they've been exactly, John. I agree too, and they've been putting these feelers out in all the mainstream financial media that these targets have not been met. These economic targets. Remember, our QE program now is data dependent, right? It's not like they keep moving the goalposts around, right? To when we're gonna taper. There is not going to be any taper because they're going to keep moving the targets around. But they're like, oh, they've been just putting the feelers out that we haven't been getting any of these targets met that we want, and that those feelers that they've been putting out is to build support, to build a consensus, to getting people to approve of more QE because they're putting the statements out there that our economy, the U.S. economy, we're underutilized in terms of capacity, productive capacity and other stuff. We're fighting deflation, credit's contracting, these types of unemployment numbers, right, John? So those types of things that they're saying, they're building the case, one statistic, one data point at a time for why they have to continue to increase QE. And I don't think, and this really sucks, and because we've talked to a lot of mainstream analysts, Keynesians and people who have worked on Wall Street for a long time, they haven't put two and two together. They still think the taper is coming. It has to come. They haven't put two and two together yet that all these data points that we're reading in the news equals more QE on its way.
Yeah. Well, the other thing is anytime there's the threat of a taper, interest rates immediately go up. Like last week when they had the quote-unquote good GDP numbers, and when I mean good, I put it in quotes because we all know it was fudged, and that was just inventory buildup.
It'll be down. It will be. It's probably seasonally adjusted already, and it will be revised downwards next quarter or quarter. It'll be drastically revised downwards. They always revise it downwards. The unemployment numbers and the GDP, they're always fudged at first to a good headline number, and a month later they adjust it down a lot, and hardly anyone even notices.
So, but I was gonna say this puts a good. But the interest rates on the 10-year Treasury immediately go up as soon as there's even a thought of taper. If they even tapered, they start pricing in multiple tapers, and the interest rates on the 10-year might go to 10%. So a lot of mainstream analysts have not put that together. And what would happen if these interest rates went up to 10% is a lot of these companies using this debt to buy back shares. Those share buybacks would turn into share dumps, and the earnings would vanish.
That's a good point, John. And one other point about the taper, John, there's multiple purposes and reasons for why the Fed's talking taper. I think one of them is to keep the gold price in a downtrend. Anytime it looks like it's going up, it almost seems like there's a new member from the Fed talking about another, we still might taper in November. We still might taper in December. We still might taper in January. Still might taper in February. Some of the ones that are starting to give up are saying, well, the Fed could still taper in March or April. But I think the other main reason for the taper, John, is the Fed is trying to prevent a stock market bubble, that Alan Greenspan type of irrational exuberance. And, we are already developing, there are early signs of the crack-up boom, that we're in the early innings of a crack-up boom where the currencies are all being debased very rapidly and the money's going into, flight capitals leaving one country and going into the markets or assets of another, and then the liquidity injections from central banks all over the world are going into the U.S. stock market, U.S. real estate market, etc. There are lots of signs of this. But I think, John, the Fed is trying to prevent the stock market from, doubling or tripling in only a couple years, because it's looking at some of the statistics like the margin debt. So you see the institutions, the big shots on Wall Street who have a lot of assets, a lot of collateral, a lot of money already, and they can essentially borrow, John, almost near zero. They can borrow basically for free, especially if you're borrowing from Japan and you're doing a carry trade. You can borrow from the Japanese bank or the Japanese central bank if you're large enough, and you can put it into the U.S. dividend stock, lever up the position, and you could get 90, 100% returns on only a 3 or 4% dividend stock with leverage. So the margin debt, John, it's at an all-time high, right?
Mm-hmm.
Yeah. So I think that's what has the Fed worried, because the name of the game, from what I've seen on Wall Street, really since 2010 and 11 and the QE program started has been to lever up your balance sheet and buy assets. Buy that real estate and try to rent it out. If you're a hedge fund, buy 40, 50, 100, 200 tracts of houses, right? And then try to get that 2 to 5% cap rate there on rental property income, even though they have no experience whatsoever managing a rental property, right? They don't know how to. I've read the stories about, they don't fix any of the problems at the properties for the tenants, all this other stuff. They don't care. But they're getting free money, and they want their, dividend stock returns with leverage. They want their rental property income returns with leverage. They want their bond market returns with leverage. They're just levering up the positions like crazy. And I think that with the taper talk, I think besides, manipulating commodities and other stuff, I think that's what the Fed is trying to accomplish, is they're trying to prevent the stock market from going into full 1999 or worse crack-up bubble mode, where, people think it's a slam dunk that the stock market is only going to go one way, and that's up, and it's going to go there very quickly.
And eventually, when everyone starts taking profits, all those buyers will turn into sellers.
Yeah, and it'll be rapid because of the amount of leverage in the system, because Wall Street appears, you look at the majority of people who are using the leverage are the hedge funds and these guys. Those guys don't stick around. Most of them are trend traders. They're not long-term value investors. They will not stick around for a 10, 15, 20% correction. They will cut their loss due to the fact that a lot of other managers, there's always peer risk and career risk in that industry. You have a lot of pressure to generate returns each day, each week, each month, and beat the next guy by a little bit. The pressure is just enormous in that industry to meet your targets and bonuses and beat your competitors. And you're just not going to see those guys stick around with their leverage positions, right, John, for a 5, 10, maybe a 5%. But they're not going to stick around for a 10%, 15%, 20% or more correction. They're going to close out the long position, and they're going to go short on leverage and drive the market down, or they're going to take that capital and go long in another market with leverage.
Yeah. Well, the other thing is about taper is one thing that hasn't that's on my mind now is, since we're talking about a trend, a lot of people, we were saying that a lot of mainstream economists and Keynesians and Wall Street people still believe that there's a taper. They're still convinced they have to taper. And next month is tax selling loss season. Do you see some great opportunities next month? Because a lot of people, they're sure there's a taper. They might just take their profits now and wait for more certainty from the Fed.
If people are trying to time the market, there probably will be an extra opportunity for some of the names that are already down. Those names will probably not be bought. So some of the commodity stocks and some of the other stocks that are down already, they will probably most likely go lower because people will take a tax loss on those, right? And there will probably be an opportunity to buy them at a better price in January. I have not sold really any of my positions. I'm still invested in the best quality, best fundamental mining shares, and also oil stocks and royalty and streaming companies. And I've started positions in geothermal. Some of those have gone down in the near term. I've been adding to positions still. And I will continue to add to positions, but I'm thinking 3-5 years out. I spent a lot of time, as you know, John, listening to conference calls, looking at earnings reports, and other things like that. So it really just depends on someone's risk tolerance. If they're going to check their account every day, time frames, things like that.
Yeah, I was just going to say, in terms of just overall trends, is I think there'll be some good opportunities in December because. Especially
or January, yeah.
Because of the gold and silver market, I think a lot of people will take tax losses on their miners, especially some of the good ones, like First Majestic. That might, if that goes down to 8 during tax selling loss season, that is a bargain and a half. That could be easy 10-bagger.
Yeah, that has a realistic upside of that, especially we know because Keith is probably the best CEO in the silver mining industry right now. And his money's where his mouth is. He has most of his net worth in the company. I think that's an important thing there. And he didn't misuse his capital. He was very smart with it. In terms of the the overall sector, I mean, the sector has just been so bad with capital and stuff like that. But we're starting to see, John, I don't know if you've seen a lot of the earnings reports, you're starting to see companies like drastically cut some of their costs. The costs have been slashed to the bone. The debt has been refinanced. The bad assets where people have been overpaid for in the past, they've been written off or sold off. The losses have been cut to put more cash on the balance sheet. So I think for some of these, now this is a stock picker's market. I'm not telling you to go out and buy every single mining stock. Some of them are crap. Some of them are crap, especially some of the junior explorers. Some of those guys are done. Well, actually, not all of them, but a good amount, I'd say, are done. But it's a stock picker's market. If you know how to look for the fundamentals, maybe you want to hire us for consulting. Cheap promo there. Maybe you want to hire us for consulting or research work or to teach you how to do these for yourself so you learn how to fish for yourself. There are some the market has indiscriminately thrown out a lot of the companies that have not deserved to be discriminated against. For example, you have a Franco-Nevada with no debt, lots of free cash flow, diversified portfolio of royalties. They're in a driver's seat right now. I believe Silver Wheaton and Franco-Nevada are as good as it gets in terms of safety in the whole gold and silver mining sector. Silver Wheaton just on one of their streaming partners, they just stole 100% of the gold production from one company. They had already gotten a 50% of a silver stream life of mine, but they also got 100% of the gold production life of mine. They got it for a fraction of what it's really worth. The analogy I like to use is that during the 2008 crash, Franco-Nevada was able to buy over $1 billion in net present value life of mine, 50% of life of mine gold production from Coeur d'Alene Mining of their Palmarejo, plus exploration upside on the gold production. They were able to buy it for only $80 million. That is one of the best deals I've ever seen. So for $80 million, John, they were able to buy over $1 billion worth of assets that will, pay for itself. Well, actually pay for itself almost already. Many, many times over. That will allow them to, pay out more dividends, reinvest into growth, et cetera, et cetera. So, that's just like what I would say. If you're still buying gold and silver here, congrats to you. You have fortitude. You have cojones. You understand the discipline and the long-term fundamentals of the market. You got to be really careful, though, on what you buy at this stage in the game. Even Barrick is in a lot of – well, I don't know if Barrick will go bankrupt, but Barrick just raised – did you see, John, that Barrick just raised $3 billion? Yeah, they just diluted the crap out of their shareholders, $3 billion bought deal financing. My guess is they were running the numbers on their cash flows, and they saw if gold does go down below 1,100 or near 1,000, they were going to be in default of some of the interest payments on their loan. They may lose Pasqualama for nothing. And their chairman of the board, well, he's a co-chairman, but one of the founders of the company is being run out of there finally. So, you got to be, just because someone is big in that industry doesn't mean they're better, especially in mining. You got to be really careful what you buy at this stage. But I think there is the potential, John, and you mentioned this earlier, to make 5, 10, 20 times your money over the next 3 to 5 years, but only if you know what you're doing, you buy the company with the right fundamentals, you do not buy all of your position at once, you keep dry powder on the sideline just in case there is more to this correction. But, either demand for metals is going to evaporate or the mine supply is going to be cut off drastically. And I don't see demand decreasing for gold or silver. In fact, there's, even more uses for silver. And investor demand, the Silver Eagles just increased a lot, right?
Well, they're at a record They're at a record high now, and there is an estimated deficit of Silver Eagles, and partly because Asia, they love those Silver Eagles. So, and in terms of gold and silver, if you're buying bullion, one thing I want you to think about is David Morgan said it might come down to whether you have it or you're not. And if the dollar crisis gets really that bad, I always think someone should diversify into foreign minted coins or bars, like the Austrian Philharmonic, the Canadian Maple Leaf. In terms of gold, the Kangaroo. The Australian silver coins are way expensive. I don't think they're worth it.
Or rounds too, right? You really like rounds because you can get those near spot, right?
Yeah, rounds are the cheapest in terms of near spot, but in terms of like an investment, I just recently bought some Canadian Maple Leafs, and one of the reasons is when this dollar crisis occurs, the Royal Canadian Mint, the Perth Mint, the Austrian Mint, they might just say, you know what, we're not going to sell to you guys anymore. Your currency's crap. So, and then when you have it and not any of them are being imported into the U.S., you might be able to sell that for a huge premium, like the Canadian wildlife coin. So that's one thing you might want to think about. I was just thinking about that. So.
And that's some very good points, John. Now, we're not going to wrap things up, but let's start going into some analysis of markets real quick for our listeners, because we haven't done this in a while. We've been doing interviews with other guests, big name guests like Mark Faber and Kevin Kerr, and our Bitcoin Roundtable. Please listen to those other podcasts. We cover a lot more things now than just gold, silver, and commodities. We cover value investing. We cover Bitcoin. We cover a lot of other technology stocks and a lot of other types of things here at Wall Street from Main Street too. So, John, let's talk about the general stock market here. What's your feeling of the general stock market, and what's going on right now, and what do you see for the near-term future of it?
In the near-term future, I think a lot of Wall Street analysts and Wall Street firms in December might start doing some profit taking because of tax selling loss, and they're convinced there's a taper. So they want to look to more, they want to get more clear direction. I think it's going to be an uptrend for at least another 6 to 8 months. I think they're going to keep feeding Wall Street free money to speculate. And they'll, of course, we know the plunge protection team will backstop any losses. So I think this will put, there's always sector rotation. A lot of the Russell Index and small caps are going into large cap companies. So I think good dividend stocks are, there's going to be a sector rotation back into there when they realize tapering's not off the table and people search for income. So just companies that can pass inflation on, like a Chipotle would do pretty well, I think.
Yeah, or a Johnson & Johnson or Costco or the cigarette companies like Philip Morris or those guys. Those are normally going to survive pretty good during almost any economic environment. Coca-Cola is diversified away from just soft drinks because they're not healthy, so they're switching to like bottled water and vitamin water and things like that. Good, solid, multinational company that has its sales all over the globe and has a bunch of different products. Those companies, consumer staples, things people have to buy that have a premium pricing power, where people will pay a little bit of extra for the brand name. I think that's a good point.
Well,
I think those companies.
Oh, I was also going to say, sorry, I forgot. Two other sectors I actually like are. One other sector I like is alcohol, because no matter how bad things get, people always drink. Anheuser-Busch is still trading at a very low valuation. Diageo, that's a whiskey company. Diageo, sorry. They're doing pretty well, and I think more and more people will drink, especially when things get bad. People drink as an escape. So, and entertainment, as you said, before,
cheap entertainment,
Disney and cheap entertainment will do really well.
Yeah, the video game companies too. So some of the movie companies like Lionsgate, with the Catching Fire, and some of the other pictures that they have coming out, those companies are going to do well. Disney's going to do well with its superhero movies. They're good, and the video game companies, some of them are going to do well. They're a cheap form of entertainment and escape from reality. In terms of the stock market, well, first, before I talk about sectors and stuff that I like, let me talk about my views of the stock market. I think with the taper comments and some of the other stuff that we're seeing, the Fed is aware of margin debt. The Fed is very aware of that. And the Fed is trying to manage the stock market through its open mouth, its Fed speak. They're trying to keep the stock market to managed levels where it gradually goes higher. The Fed does not want the stock market, to just take off. They do not want that. But it might happen anyway because, markets don't do what the central planners and the Keynesians want it to do. They may for a while, but eventually they won't. It's proven that time and time again throughout history. So that would be my view of the market. The Fed wants it managed higher thanks to the wealth effect and other reasons. There's very large reasons from D.C. and also from Wall Street why they want the stock market to go higher. People on Wall Street get very large bonuses, and they're getting free money to speculate on higher asset prices. So the money managers get everyone's happy with higher asset prices on Wall Street except for the shorts. And then people in D.C., they make more money on tax revenues when the asset prices go higher. They make much higher. So they can create that inflation, put in asset prices, say there's no inflation in the real economy through phony Bureau of Labor statistics, and take out more of your wealth through higher asset prices when you pay the tax man for dividends and the capital gains taxes on other stuff. In terms of what I see in the stock market, I really like Facebook and Google. I think they are trades. I don't know if they're investments for the long term because they've already gone up a lot, although Google has a really large pipeline. But I made a Facebook call at 30. I thought it was a good buy after it corrected a lot because I had started to see some huge improvement in its financial statements, especially in its income statement. And I think Facebook's probably going to go a lot higher. I don't know if it's going to go to 100 or 200 or anything, but I think it'll go higher from these levels. It's in an uptrend. Google, these are for short-term traders, by the way, not for long-term investors. I think Google will probably be the next very large bubble that the hedge funds will create. I think the hedge funds will push Google way higher. Twitter looks like it may be a bubble, but I do not like the financials of Twitter. They have not proven they can make any money. In fact, their losses have gotten even larger the more money they've spent and raised. So I think Twitter is going to have some trouble with advertising, but the stock may go a lot higher. In fact, I told people before the IPO, the stock was going to go a lot higher, but I didn't think it would go high on any fundamental reasons at all. Just that people were going to buy it and say, hey, I love Twitter, I'll buy the stock too.
Yeah, that's true, and they have negative profit margins too. So
Exactly, and if you and that this is not even pricing in the lockup period. The thing about an IPO is Twitter does not have good financials, but I don't know, 4 months from now, 6 months from now, 8 months from now, whenever the IPO lockup period expires and insiders are allowed to dump their shares because there's a certain amount of time insiders have to wait before they're allowed to sell their shares, I expect there to be a very large share dump in Twitter whenever that first and second lockup period expires. I think it's going to be absolutely large. But, I could be wrong, but if I had to make an educated guess, that's what I see. The other things that are in clear uptrends to me, John, and some of those reasons are fundamental. You have fundamental reasons for Google and Twitter going higher, but it's a matter of valuation for me. I just, as a long-term, I'm mostly a long-term value investor. I just don't like the valuations really on those right now. But the other stuff that's in a clear long-term uptrend, and at least for the short term, it's a good long trade, is the U.S. oil refiners. They have that spread from that cheap Bakken light sweet crude, and then they're going to export it at Brent prices, right, as their finished product. Mm-hmm. So that long-term fundamental trend doesn't look like it's ending. The shale oil drillers, Schlumberger and those guys have humongous order books, right, for a long time. So they have business for a long time for the drilling. And then some of the shale oil producers. So an EOG Resources, a Pioneer, Kodak Oil and Gas, Cimarex, and some of those others.
Yeah. Well, the fracking companies, I think, will be a good, like the oil service sector companies, such as Baker and Hughes and Schlumberger. They have strong fundamentals, too, because of the I was going to say the national oil companies. So I think the drilling companies are a good trade and investment.
Yeah, I agree, John. But the thing is, though, for some of these shale oil producers, if you look at their financials, they're the drillers. Oh yeah, the service companies are a lot safer.
Not the drillers, the service companies. They do the drilling, but they're the service. Not
the producers. Yeah, not the E&P guys. Yeah, I know what you mean. The thing is, like, I think the drillers are way safer, like Schlumberger and Baker Hughes and Halliburton. Those guys are in the driver's seat right now because they're teaching the fracking technique to a lot of foreigners, and they're doing all the octopus drilling is a lot more efficient, the octopus pads. For listeners out there, if you want to see some cool technology, take a look at the octopus pad drillers that are going on in the Bakken and other areas. It's pretty amazing. The thing is, like with the shale oil producers, only EOG Resources really, to me, in terms of looking at their financials, has like a pretty good balance sheet and stuff like that. But I mean, these guys are like in really strong uptrends, and the market the market is assigning a much higher valuation and multiple to those types of companies than a foreign oil producer. You know, even a deep water guy who has like wells that last way longer, that don't deplete as much. The market is just obsessed right now with the shale oil producers here in the U.S. The guys in the Bakken, in the Eagle Ford, in the Permian, those stocks are just exploding right now. They have some fundamental reasons, obviously, because there is production growth, and they found more. Well, the reserves were always there, but I guess they've proven more of them up. But I just don't like them as a long-term investment in terms of like they've already run up, right? Some of them hundreds of percent.
Yeah.
As a value investor, that always worries me if something's already up hundreds of percent, how much more upside it has.
Well, not only that, like Kodiak and Oil and Gas has 76% institutionally owned. So once the institutions decide they want to start selling something, the price rapidly deteriorates.
Good point. Very good point. Very good point. And for listeners out there, that's a stock I bought at 2. Yeah, it's at, what, 12 now or something like that? Yeah, so, I mean, buying a stock at 2 and then it goes up to 12, I mean, how much more upside is there? Should I take some gains off the table? These are some things you think. I already, for full disclosure, I already sold my Kodiak oil position. I sold it early at 6. Obviously, I missed out on some big gains, but I already had a triple, and you know, I just didn't like a lot of their financials and how much debt they were taking on to produce the oil, because other oil producers outside of the U.S., they normally can generate more free cash flow, pay more dividends and stuff like that. For comparison's sake, look at the balance sheet of a company like Pacific Rubiales, which is a very strong mid-tier producer outside the United States. They're diversified all over South America. Don't they have a rising dividend, John, right?
Yeah.
Free cash flow, good wells, yeah.
They have a rising dividend, and they're buying up more and more assets. They just bought I forget the name of it. It's Petronielas. It was a really good company with lots of assets, and they just keep rising it. They wanted to do a share buyback program, but they decided on adding to their asset base, and they have production growth every year till 2016, and they're probably buying up more assets so they can continue production growth after that. So I really like them. I think Pacific Rubiales is a great one. It pays a good. It has over 3.5% dividend yield, and it's only $19. It's way better than any shale oil company that gives you a 3% dividend yield, and it's way cheaper.
And their financials are more sound, right? They're diversified in multiple countries. They have better profit margins, right, et cetera, right?
Yeah.
Yeah, so I mean, like, for long-term value investors, compare what you do. Everything's on a relative basis, guys. So compare the financial statements of a Pacific Rubiales with that of the financial statements of Pioneer Energy or Cimarex or Kodiak Oil and Gas, and we think it's night and day, right, John?
Oh yeah, like Mart has. Look at their profit margins. I think it's like a 40%.
Net profit margin, yeah. It's above 35% net profit margin, not gross. Yeah. So those are just some of the examples of, you know, the market hasn't recognized value, or it's just chasing a strong uptrend. In terms of wrapping up the podcast, let's just talk about then, just quickly go over maybe some of the other areas you see value, maybe some of the commodity sectors you're adding to positions, or you still see some value then before we wrap this thing up.
All right, I guess. Well, do you want to go first, or?
Yeah, we'll just go over things. We'll just go through the whole commodity complex if we can remember. Potash, it looks like potash is bottoming out. I mean, I thought it had bottomed before that cartel had split up there with the what was it, Belarusian or Ukrainian one? I can't remember.
Well, we know it was the cartel and it involved Russia. You know, Russia has a cartel on some commodity.
Well, yeah. Russia had a large potash company, I think, and Ukraine had one, and Belarus had one, and one of them was leaving. There's two cartels in potash for listeners out there. There's Canpotex, which is in Canada, which is a combination of like part of Mosaic's ones, and then Potash Corp, and then there's the one in like the Eastern European one, which is a combination like Belarus and Ukraine and Russia. Mm-hmm. So that one broke up, and then the market panicked, and so those stocks had already been down a lot. And the potash companies had already cut production. They had cut investment in exploration, et cetera, et cetera. which is signs, a market's going to bottom or in a bottoming process, and then the stocks went down another 20, 30%. That looks like we finally bottomed in that sector because I think, John, food prices are finally starting to rally. So we're starting to see food prices go higher, and that, of course, means farmers are going to plant more food, right? So that means then more fertilizers.
Yeah.
So normally, unless they're doing organic farming, which most people don't do. Most people use the non-organic farming. They use the synthetic fertilizers, which are the fertilizer products that like Potash Corp and Mosaic and Agrium and those guys sell. That's one sector. Uranium, I'm still bullish on it. Earlier in the year, like in our 2013 podcast to start the year, John, you thought uranium would be a good year. I disagreed with you on 2013. I said 2014 would be a good year. Looks like you're a little early, but 2014 is looking like a good year though.
Yeah, the megatons megawatts deal ends, and there's so many free trade agreements. Canada just signed one with Europe to export uranium to Europe, so it's a great bargain. And not only that, not a lot of the miners can make money. So you're buying, could it go down a little more? Sure, but you're buying it near the bottom. When the miners can't make money, supplies comes offline, and then prices have to rise.
And Cameco has what a 1 point, the dividend over 1%, right? So you're going to get it paid to weight in the safest uranium one, and a lot of their uranium production, right, is either used for their own nuclear power facilities in Canada, or they're selling it above spot. They're selling it at a long-term fixed supply contract above spot price, right, to other utilities in China, right?
Yeah, they have an over 2% dividend, so you got plenty of time to wait.
Yeah, so you're getting paid to wait, so that's good for long-term value investors out there. Stock might not do anything for a while, might go a little lower, but it's going to be very sound, and you're going to get paid a decent yield to wait. In terms of other commodity sectors, let's talk about rare earths real quick. I mistakenly thought this year would be a good year for rare earths. Great Western Minerals and Molycorp and Lynas have not executed at all. They've still had a lot of problems. They have good business plans, but they have not executed them properly at all. So there's still been, the stocks have gone down a lot. All in total over the last, I think 3 years, most of those stocks are down like 90% from their bubble. 2014, I was wrong about that, so I'll admit that, about 2013. 2014, though, may be a good year. I would look for Molycorp. China started to stockpile rare earths again, and a lot of the other people who were buying finished magnets and other stuff have started, they had a lot of inventory and they've worked through them finally, so they're going to start stockpiling. But I would watch Molycorp and see when Molycorp or Lynas finally turn a profit. That could finally start to buoy some of the other ones. But in general, I think a lot of the companies in the sector, and there were dozens of them, they raised way too much capital, and a lot of the companies are never going to go into existence, and they're going to have to hope to sell out to Molycorp or another company for pennies. I only think there's about, at most, 5 to 7 viable companies in the whole industry. So 2014 will hopefully be better for rare earths. 2013, it was looking like it would be promising, but there was a lack of execution on business plans that were actually pretty sound, in my opinion. That happens sometimes. You have a good business plan as an entrepreneur or a business person, and you just don't execute. That's life. That's what happened in the rare earth sector. Hopefully 2014 is better for them. I would listen to conference calls and check that before I bought anything. I do not have any positions in the rare earth sector right now, but I may start buying in 2014 because the valuations are starting to get so negative, so cheap, so low that when one company turns a profit, it might be like a rocket pack to one or stock or the whole industry. In terms of the other commodity sectors, John, platinum and palladium, supply deficits there, right?
Yeah, biggest, I just read this about an hour ago, but platinum is supposed to have this biggest deficit since 1999. So palladium's really held up despite this crash in metals. It's still above 700. So I think platinum and palladium is really, it's going to be a good buy. It's in a deficit, so it has to rise.
It's exactly, John. And there's a market, it's very similar to silver, where there is potential supply issues, and there's also demand drivers. So you have China, who wants to who has increased the smog regulations for their cars finally. Finally, because if you look at the videos in China of all the smog and pollution and stuff, they're giving all their citizens horrible asthma and other health problems from all the smog. It's gross. Look at the videos online on Bloomberg, on YouTube of China smog. So they're going to put catalytic converters now as mandatory requirement in all their cars. I don't really like government mandates on things. I'd prefer free market forces, but this might be a case where, like, the government one rule might actually be a good one where, people aren't going to get asthma, because I have asthma, and it's not a fun thing to have when you're coughing and, stuff all the time.
Yeah.
So that's something to think about. The for-profit education stocks, which was a value investing proposal I had a few months ago, those things have started to rebound and are doing well. They are adjusting to not as much, I think, money allowed, more government scrutiny, not as much student loan money being given. They're going to adapt. They're going to cut their tuition prices. They're going to want to put butts in the seats. This is a private enterprise, so maybe the overall earnings power of those businesses is not going to be as high as in the past, giving the government's artificial credit-fueled boom that was happening in the student loan bubble. But you know what? That industry, the market was pricing in bankruptcy for all these guys. People are going to who come to this country, who are driving taxis or other jobs, immigrants. They're going to want to learn an education where they don't necessarily have to take the SAT or the ACT or any of these other things. They're going to want to add skills. So I think for-profit education stocks are still an interesting long-term value proposal. This is not commodities. I'm just going down my list here, folks, of some of the other commodity lists that we talked about in past podcasts. Geothermal, I think I've talked about this on the last one. There's only a couple companies to invest in. This will take at least 18 total months for this to play out. But I just listened to a conference call for Altera Power, which is Ross Beatty, one of the richest men in Canada, Canadian billionaire, a.k.a. the broken slot machine, who was buying 7.5 million shares of Altera Power on the open market back in June. I just listened to the conference call for this past quarter. This company, you might not be able to tell this from a 29-30 cent a share stock, but their earnings are improving quite a bit. Their EBITDA, earnings before interest, taxes, depreciation, amortization, is up a lot, and they're increasing wind farms, solar farms, geothermal plants. They are going to have a massive amount of additional electrical capacity and power generation online by 2015 if they execute their business plan, and I think we're looking at capital gains and a potential small dividend by 2015, 2016. For these types of geothermal companies. They've got a lot of their financing in place, John, already. Their business plans were always sound. Utilities do well. They're local monopolies, a lot of, good things for that. But they're still going through their growth phase right now. But I think once the market realizes their earnings, the free cash flow is there, and the dividends are going to start coming, these things are going to explode.
Yeah. Well, another sector I like, which I don't think it'll have a banner year this year, but I think the stocks will outperform, is North American natural gas. I think the bottom's in for a lot of these companies, especially since they're moving a lot of their production from natural gas to oil. So their earnings and cash flows will improve. And Canada is looking to open up export terminals so they can ship their natural gas to China, who has a trade deficit. So that will increase the North American natural gas price. And in 2015, Cheniere Energy, their terminal's coming online, so that will definitely increase the price of North American natural gas. And all the write-downs, that natural gas is still there, so the natural gas production is still.
And they're flaring it off. The shale oil producers in the U.S., like Kodiak and EOG. They don't. The price is a natural gas price is not high enough for them to produce it and store it and ship it, right? So we're at a stage where the natural gas price really can't go much lower. It just can't, because the guys are all going to go out of business, and the demand globally for natural gas is increasing. So that's why the LNG stocks, like the LNG tankers, the LNG export facilities like Cheniere, which Wall Street for Main Street, by the way, John, recommended Cheniere at 6 starting in 2009. After the crash, and we told people to hold through all the ups and downs, and the thing's what, at $35, $40 a share now?
It's at 40.
Yeah. So that's what almost a 7 bagger. Yeah.
Yeah.
That's almost a 7 bagger.
Yeah.
if you just diversified your portfolio outside of gold and silver and stuck with that trend, you're going to see LNG companies. There's also MLP ways to play LNG too. There's for people who need dividend yields. There's a lot of LNG plays. There's like 3 or 4, and there's going to be even more that are going to make money generating good cash flows out of this. So I think that's a strong trend. I think John is
and I like the tankers.
Yeah. Oh, the LNG tankers, yeah.
Yeah, I think they're great, and with China doubling import capacity, those tankers will need to be put to good use. Those are great. A lot of them pay good dividends. GasLog's been doing pretty well. Valuation, it's a little high, but they have growth every year up until 2018. So their earnings and cash flows are going to be relatively stable.
John, the market, the thing you mentioned about valuation and a little high, as long as the market knows there's good probability of growth like that and there's good cash flows and dividends are increasing or something, the market is going to reward a higher valuation multiple for a growth like that, for a growth story. So then it's not overvalued. Then
I was just going to say. Yeah. I was just saying, if people look at it and say valuations are high, it has growth. They've been increasing their dividend. A lot of these companies are doing pretty well. Golar and GasLog are the biggest, no-brainer tankers. Could they go down a little bit? Possibly, but they won't stay down.
Okay, so for oil producers, I think the better value for the oil producers, a lot of them are the junior oil producers or the mid-tier guys outside of the U.S. Even though the Brent prices are higher than the WTI, the market is paying a way higher valuation multiple for United States, U.S. shale oil producers. Compare the valuations, and then you tell us what you think. You can email us at Wall Street for Main Street at Gmail, WALLSTFORMAINST@gmail. Let me go down the list here, and then we'll wrap things up, make sure we covered some of the other undervalued ones. I really like some of the technology sectors in the stock market. There's some good value there depending upon the company. If you have an opinion, if you want us to look at a stock or you want some consulting work done or you know a good technology analyst, email us and we'll get them on for a podcast. We've been wanting a good technology analyst on for one to talk about some value and some of the different technologies out there like 3D printing, robotics, cybersecurity, big data, data mining, some of the software breakthroughs, things like that. Lastly on U.S. natural gas producers, John, there's really only a handful of really sound ones right now who have decent balance sheets, right? There's not too many of them, right? Because most of them are kind of like at the mercy of their bankers, right, to survive.
Yeah, there's a good amount, but their cash flows are improving because a lot of them are readjusting and going to oil in some of these, so their cash flows are increasing. But yeah, there is a handful of some, and I would say the ones I like are Encana. They have some good growth coming on. They have natural gas liquids, which there's different types of natural gas. There's dry gas, methane, liquids. Liquids is the cheapest, most cost-effective natural gas to produce. And Encana has a lot of that, and they have cut their dividend. They're shoring up their balance sheet, and they have growth coming on. So I think once the price increases for them, they're going to do really well. Chesapeake, the worst is definitely behind them. They're producing more oil, and they still have a lot of natural gas. It's been written down, but it's not. So I think some of these, and Abraxas, that's a junior that's making money now, and it's had some good quarters. So I'm not recommending Abraxas. I haven't really looked at it very well.
Yeah, I think Devon is really good. I think Devon Energy is a very sound one, and I think Ultra Petroleum is not bad either. And in terms of the junior one, there's one that T. Boone Pickens and Wilbur Ross, I think both are invested in. That's Exco. That pays a yield. That one's pretty leveraged, though. But it's well backed. It's backed by, all the big oil and gas players. You got 2 billionaires right there alone who are backing that one. So that's one for U.S. natural gas producers. Be very careful which ones you buy, though. But this is probably the bottom. Let me just talk about coal. I think, first I think the food and the agribusiness ones, so like Archer Daniels Midland and some of those are good plays because I expect food prices to go higher through the inflation that's exported outside the U.S. I think that's going to be a trend going forward because I think Kevin Kerr said this. There's going to be on another podcast last week. There's going to be more Arab Springs going forward. So I think that's going to be as a result of higher food prices and higher inflation outside the U.S. And I think coal prices have bottomed. I think, enough coal companies have gone bankrupt. They've restructured. What you have seen also, John, with coal is you've seen hypocrisy from Europe. You've seen, John, can you hear me?
Yeah, I can hear you fine.
Okay, you've seen the European utility companies and European governments start stockpiling coal, even though they're hardcore environmentalists, right? Because they don't want to do nuclear power and they don't want to allow fracking in their own country, right?
Yeah.
So they're buying coal and they're doing that. So it's total hypocrisy. But people make economic judgments and they ignore their politics when it means keeping the lights on and keeping their family fed and their homes warm in the winter, right? So I think coal is bottomed. And also another reason is India has started copying China on their commodity policy. The Indian government has finally started to massively accumulate key commodities at bottoms when a commodity price drops. So in the past, China would sector rotate when a commodity collapsed. China was buying oil at like $40, $50 long-term contracts when oil collapsed to $35 in 2008. They were booking long-term deals with Brazil and Russia, right? India and China was also buying uranium on long-term contracts after Fukushima. India has copied them finally. India has been buying copper and coal like crazy the last 6 to 12 months. They are sector rotating now. So India has helped put a bottom in coal. I think that also the same thing for base metals too, for copper and high-grade iron ore and steel. China and India have started buying those. Obviously, China has a lot of paper to get rid of, so they can't put it – we've discussed this at length. They can't put it all in precious metals. It has to go into oil and base metals and other commodities. I think base metals have already gone up quite a bit. Same thing with I don't know if coal has, but I know base metals and steel have, and they just got Goldman Sachs upgrades. That might be a short-term uptrend. I am not convinced, though, that those are long-term fundamental investments because they're too dependent on real economic growth, and I really don't see that. So I think those made good trades if you bought them 6 months ago, 12 months ago, when people were dumping them like crazy. So sorry we didn't recognize that trend. But there might be a little bit of trend left. If you're a trader, you can set tight stops, play that trend still and set tight stops on your trades. Worst case scenario, you get stopped out at a small loss. The last but certainly not least for commodities is gold and silver miners.
Oh, one other thing I forgot to say is another good one is in 2014, zinc, half the supplies. It's going to have a huge supply deficit. So zinc, if you can find a high-grade, well-capitalized zinc company, that it looks like a good long-term trend.
Yeah, there's a couple juniors out there. There's Trevally, which some other analysts were friends with, and then there's Canadian Zinc, which has some of the highest zinc grades on record of any deposit in the last 30, 40, 50 years. I think Sandstorm Metals and Energy already locked up a streaming agreement on some of that zinc. But obviously, that's going to take a couple years for that deposit to come online. But those are more speculative, though. They're not earning any money. I don't think Trevally's making any money yet.
Yeah.
Not sure though. I haven't looked at the company that much. Those are the only two names I know of. But there's other commodities out there like graphite and things like that. Those markets are going to take some time. They're more tied to innovation and things like that we talked about in the past. But the last market that we want to cover today, before I lose my voice entirely, because we've been going for over an hour, record. Well, not a record, but anyways, though, is gold and silver miners. John, we'll wrap up the podcast with that. I don't know about you, John, but I am seeing a divergence in gold and silver. I am seeing the ones with the best the gold and silver miners or royalty and streaming companies with the best fundamentals. Those things I can tell are being accumulated almost every day, regardless of the spot metal price. And the ones that are higher risk, some of the junior explorers and stuff, are not being accumulated. Those are still going down.
Yeah, I definitely see on Friday, I remember, I don't know if it's Friday or Thursday, but one of the days last week, I posted it in our treasure hunting group. Gold and silver went down big time, but the Huey was up. And a lot of good miners are being accumulated now, fundamentally. And it's not just royalty and streaming, but it's also the good miners, like a Gold Corp or New Gold or something like that. They've been going up.
Or Yamana, yeah, those ones. Or First Majestic Silver, or some of the, those ones are being quietly accumulated. And, it's not just gold bugs or silver bugs like me and John, folks. Some of the top value investors now, right? The institutions, the private equity guys, the hedge fund managers, they're making calls. They're going in. Rick Rule actually just said that this is the time he thinks we should go all in. I just heard that this week. And he thinks the bottom is in. And he talks with a lot of institutions, and he didn't think the bottom was in for a while, but he thinks and he's a noted value investor and commodity expert, and he actually called the drop in gold price down around 1180. He actually called that ahead of time.
Well, I was going to say this. I interviewed Sean Hyman, and he's not really necessarily a gold bug, or he doesn't really have any type of I would say strong beliefs or anything. I'm not going to say he doesn't have any beliefs or anything, but his investing philosophies, he's contrarian. He just buys things that are hated. And he's told us on that podcast he loves gold equities right now. So he's not necessarily like a stacker like me, but...
Yeah, good point. Good point, John. And, one other thing, like top hedge fund manager, this guy's a value investor, Seth Klarman. Normally, value investors, guys who follow Warren Buffett and Benjamin Graham, will not buy gold or physical metal, even though Warren Buffett did try to corner the silver market, but no one likes to talk about that. He did try to corner the silver market in the 90s and up to like the early 2000s. Go and look it up. He tried to corner the LBMA market. He bought over 100 million ounces of silver, I believe, and they moved that position into the SLV. Wink, wink, nod, nod. Anyways, he was told to get out of the market, but that's another story for another time. But this noted value investor, hedge fund manager, is named Seth Klarman. He's buying gold and silver stocks. So these are mainstream value investors, guys who would normally not buy gold and silver stocks, right? Because they don't know how to value gold. They don't want supply-demand fundamentals. They normally won't even buy miners or commodities or anything, right? Because they don't see it as a free cash flow machine, and they're starting to accumulate positions in these stocks. So I think this just continues to add to the argument, John. It looks on the price action for the really quality stuff. Now, I'm not talking about every gold and silver miner. There's a big difference here between buying Junior Explorer, who has no cash left in the bank. They're giving out shares in exchange for keeping the stock listed on the exchange, right? Things like that, right?
Mm-hmm.
Big difference between that and Franco-Nevada or Silver Wheaton or Gold Corp or any of those other ones. It's a stock picker's market, folks. You really got to make sure, if you're putting money to work, you really got to make sure it's in the right company, gold and silver company with the right fundamentals, who can survive any further downside, even if we go sideways, who can survive this for X number of months. But I think we're putting in this final bottom here. We may go a little bit lower, and then that's it, because then production will shut off. And then 2014 is going to look a little bit better, because Yellen will probably increase QE, as we've said. And in 2014, we're probably going to start accelerating higher by the end of 2014, 2015, 2016.
Yeah, we just don't know what's going to be allowed to be priced into the market. All these fundamentals we talk about, if they're priced in at once, we could wake up and gold's double. So we have no idea. I'm guessing it will be a slowly crawl, but...
Yeah, I mean, people out there who don't have a position already or who've panicked and sold out of all of their gold and silver and they're chasing Bitcoin. By the way, I think Bitcoin's going to go a lot higher, but I think the hedge funds are involved in that, and it's going to turn. There are some fundamental reasons for Bitcoin for owning it. I think it's good insurance for gold and silver, like also owning platinum and palladium in addition to your gold or silver. But I think with Bitcoin, I think the hedge funds are going to turn into a bubble, because I'm hearing stories now of hedge fund managers who have lots of money, hundreds of millions, if not billions of dollars, assets under management, who are telling all their clients to start buying Bitcoin. So, and just for not fundamental reasons, just because it's going to go up.
Mm-hmm.
So, I'm not saying Bitcoin's a bubble yet. I'm not saying you shouldn't own Bitcoin, but, You don't know what the governments are going to do. You don't know if there's going to be a huge capital gains tax in the next 6, 12, 18 months put on Bitcoin for any U.S. residents that, if you sell Bitcoin, you're going to have to pay 60% of your paper profits in taxes. It might be smart if you've already bought Bitcoin around $1 to take some half your money or 20% of your money off the table now before any of those taxes or potential clawback or any of the stuff the government could potentially do. Because let's face it, John, you talked about gold and silver and the manipulation, all this. We only briefly talked about in this show. Listen to our other podcasts if you want other examples of this. But the governments can change, all governments can change the rules anytime they want. They can. So we don't know what's going to happen. I mean, if the U.S. government, if things hurt with the dollar, we lose petrodollar, they could go after the earnings of the shale oil producers, right, John? The taxes could increase. The royalties could increase. This is a hypothetical. We don't know what's going to happen going forward.
Yeah, we have no idea, what their reaction will be, because trying to rationally figure out what irrational people are going to do is very hard. So we don't know exactly what's going to happen. And here's the thing is, where I used to work, my bullion company I used to work for, they wrote a newsletter saying that they think capital controls could be on the way. And if that does happen, they could just shut down online exchanges. And you might not be able to access your Bitcoins. So that's why I would say take at least some profits now. Because you don't know. Governments are, one thing we do know is they want to protect their monopoly on money.
Exactly, John. And yes, they can't completely just eliminate or destroy Bitcoin because it is decentralized, and they can't do it without taking down the internet. But they can go after the exchanges. They can put humongous capital gains taxes on Bitcoin like what they did with gold or silver, where gold or silver in the U.S. are taxed as a collectible to prevent people from buying it. So we just want our listeners to know out there, you are going to have to be nimble. You're going to have to check the tax laws. The governments are going to change the rules. They're going to go after your assets. They're going to try to increase taxes on things that are going up that they don't like. It's just the world we live in right now, unfortunately. And I only see things getting worse. So I think what John recommended for Bitcoin and profits is, put a rule in place. If you bought Bitcoin under $1 or $1 and you have humongous gains, I would be taking profits every $100, a little bit of money off the table every $100 Bitcoin goes up, and diversifying it. Put that money into dividend stocks, buy a rental property and tenant it out for cash flow, buy dividend stocks, buy technology stocks, buy physical bullion, gold, silver, platinum, and palladium, buy the best fundamentals resource stocks, and be diversified like that. And I think you're going to survive this, whatever's coming. Inflation, deflation, stagflation, any of the crazy scenarios. So, you have anything else to say, John, or before I run out of my voice here?
Just close up one thing, and if you have the portfolio, you can always get rare art, wine, other sort of those unconventional investments, but you'd have to know what you're doing.
The problem, John, with that is those things, some of them have already doubled in price the last 6 to 8 months. King World News ran a story on this, and other people are running stories on this. So
that's
people have
diversification.
Yeah. But I mean, rare wine, art, collectibles, antiques, diamonds. Some of the prices on those have gone crazy because I think some of the people who maybe in the past would have bought gold and silver are guessing governments will confiscate it or tax it more. Or they're really upset with the price action. And you know what? That's what the central planners want. They wanted look at what happened during the London gold pool in the 1960s and other times during the long history of manipulation of gold. And I said this to John too. There was the only time in the history of the gold market in modern history was from 1974 really to 1980. Where the gold price was allowed a free market force, and look what happened to it. And the government still ran, TV ads. The mainstream media, Wall Street, was telling people not to buy gold. Anytime the gold price dropped, they were saying it's a bubble, it's over, things like that. But it was allowed free market forces, and the whole world wasn't allowed to buy it then. So eventually, free market forces will probably prevail unless all the governments of the world coordinate to stop it, outlaw gold or whatever. But then, it's going to create unintended consequences with silver or mining stocks or platinum or palladium or Bitcoin. I think a lot of people who, judging by the sentiment that I've seen on Facebook and others who were in gold and silver, have given up, and they've moved money into the stock market or Bitcoin. So I'm a long-term value guy. I tend to not want to chase trends higher, and I think gold and silver, some of the mining shares with the best fundamentals, oil stocks, some of the other value plays we mentioned, those things are going to do very well over the long term, regardless of inflation, deflation, stagflation, whatever.
Mm-hmm.
Okay, well, John and I want to thank you, listeners, if you've braved this with us. We're almost at hour 20 right now. And if you have any questions, comments, concerns, any investing ideas with any of the sectors we discussed, or maybe you found another value investing sector for us to look at for all of our portfolios, you want to email us. You have a new podcast guest for us to bring on, maybe in technology sector or value investing or something like that, or you can hook us up with David Einhorn or Kyle Bass, wink, wink.
Or
please,
Porter Stansberry, if you can get him.
Yeah, or Porter Stansberry or Seth Klarman, or any other big name guests that would be interested in discussing free market principles, value investing, technology, things like this. Please email us at Wall Street for Main Street at Gmail. That's WALLSTFRMAINST@gmail. You can sign up there on our website. Please like this video, and you can sign up on our website to have a chance to win a free Silver Eagle that we give away about one a month. And we also have our free oil report, which sold for $150 a copy at one point. We'll email you a free copy if you want to learn more about the oil market. So thank you guys for listening to our podcast. It's a little longer than normal, but we had a lot to talk about. And hopefully you got some value out of this. We think we provide some of the best value of anywhere on the internet in terms of learning investor education, research. And thank you again for listening, and we'll be back on soon.